Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
So this week, the UK economy feels, well, fractured, doesn't it?
Yeah, it really does. It's less a mixed picture and maybe more like a tale of two parallel economies running side by side.
Exactly. On one hand, you've got these truly historic, almost monumental global bets being placed on Britain's tech future, particularly AI.
The AI boom, yeah.
But then running right alongside that, there's this persistent, almost gnawing domestic anxiety, worries about jobs, pensions, some staggering fiscal pressures too.
And that core contradiction is precisely what we need to get into today, I think, because the tension between this huge international capital inflow and the intense strain people are feeling at home, it isn't just a macro story.
No.
It's actively rewriting the compliance and regulatory playbook for, every firm in the city.
So we really have to understand this split, especially, I suppose, the Bank of England's tight control versus the FCA's, almost sudden shift on risk.
That's the crux of it. Okay, let's start with that big picture, the macroeconomic tug-of-war. You mentioned the investment side.
Yeah, this significant tailwind of international confidence, mainly coming from the U.S. The government secured a huge commitment, a $150 billion investment package from American companies.
Which is a headline number, but it feels concrete this time, doesn't it? Not just abstract announcements.
It seems so.
We're seeing actual investment in buildings, people across the country, like Citi, for example. They're putting $1.1 billion into their UK operations.
Right. That includes the big refurb of their Canary Wharf headquarters and boosting their Belfast operations, too.
Exactly. And then you've got BlackRock doubling its footprint up in Edinburgh, going from 800 staff to 1,400.
Wow.
And PayPal committing $150 million just on product innovation based here.
So that's clearly a very strong statement of global confidence in the UK. But almost immediately, that optimism just slams into this immense headwind. And that's being created by the Bank of England's ongoing monetary tightening. Quantitative tightening, QT.
That's the critical counterpoint, isn't it? The Monetary Policy Committee, just after its September 2025 decision, kept the bank rate at 4%.
It was a 7-2 vote, I think.
Yes, 7-2 majority. And they confirmed QT continues. They're reducing the stock of government bonds by another 70 billion pounds over the next 12 months.
Now, that is actually a slowdown from the previous year's pace, isn't it?
It is a slight slowdown, but the financial hit from these sales is still, staggering.
The projected cost is just eye-watering. The Office for Budget Responsibility, the OBR, they're forecasting QT will cost the UK taxpayer something like $134 billion.
$134 billion.
That single figure almost wipes out the entire U.S. investment package we were just talking about.
And that comparison really shows the dilemma perfectly, doesn't it?
Yeah.
To make those losses real, the bank is selling assets it bought during the quantitative easing phase, when rates were rock bottom, into today's much higher interest rate world.
There was that stark example in the source material.
Yeah, the 2061 government gilt, bought for $101 not that long ago.
Sold recently for just $28.
A 73% loss on just one single asset. Now, of course, the bank defends the long-term stabilizing impact of QE.
Sure.
But the immediate fiscal pain from unwinding it from QT is undeniable, huge pressure.
And it really highlights how out of sync the UK seems this week compared to major partners. While the Bank of England held its rate.
The U.S. Federal Reserve actually cut the federal funds rate, only by 0.25 percentage points, but still.
And they specifically cited downside risks to employment as the reason.
Exactly. So our paths have really diverged there, based on quite different readings of the economic tea leaves.
It just shows the complexity the MPC is grappling with, I suppose.
Right.
Managing that lingering inflation risk, defending this necessary but, hugely costly unwind of past policies.
While the U.S. is already shifting focus to supporting jobs. Different priorities right now.
Okay, let's shift from that macro divergence to the labor market, because here the contradiction feels even sharper, maybe more personal for people.
Yeah, we're seeing what analysts are calling the Great Stay.
A complete U-turn from the Great Resignation we heard so much about.
Absolutely. Workers are opting for security over moving jobs. They're clinging on amid all this uncertainty.
And the stats really back this up, don't they? This domestic jobs drought.
They do. Job vacancies have just plummeted. from a peak of about 1.3 million.
Down to just 728,000 as of August 2025.
Yeah, a really steep drop.
So that means the competition ratio, the number of people chasing each job, has shot up?
Massively. It's gone from almost one unemployed person for every vacancy back in mid-2022
So roughly 1.1.
to now 2.3 unemployed people fighting for every single open role.
Wow. What's driving that?
Well, there seem to be two main drivers. First, there's a fiscal one. That $25 billion tax hike through increased employers' national insurance contributions.
That went from 13.8% up to 15%.
Right. That's made hiring significantly more expensive. So you're seeing widespread hiring freezes because of the cost.
Okay, that makes sense. And the second driver?
The second one feels perhaps a bit deeper. It's genuine anxiety about technology, about AI replacing jobs.
And that anxiety is definitely being voiced loud and clear by some industry leaders.
Yes.
James Reed, the CEO of the big recruitment firm, he gave that stark warning on LBC, didn't he?
He did. He said, and I'm paraphrasing slightly, we may be facing as big a disruption to the workforce as we saw in the 1980s.
Except this time, white-collar jobs rather than blue-collar ones will bear the brunt.
Oof. Yeah, that's a warning that must send a real chill through a lot of our listeners, particularly those in financial professional roles.
Absolutely. It demands a strategic rethink, sure.
It has to, and yet at the exact same time, this AI industrial revolution is literally being built under our feet.
Funded by that huge wave of foreign cash we talked about.
Entirely. Microsoft is making its largest ever UK commitment. What is it, $30 billion?
About $22 billion, yeah. A massive sum.
And the commitment to the actual hardware, the AI infrastructure, it's unprecedented for the UK.
You've got NVIDIA, Kneescale, CoreWeave. They're investing up to $11 billion together.
To build what they're calling AI factories, deploying up to 120,000 advanced GPUs.
That's the largest AI infrastructure rollout in UK history, isn't it?
By far. And it's explicitly designed to power things like OpenAI's Stargate UK initiative.
So the UK is clearly making this enormous strategic gamble on leading the world in AI.
Relying heavily on foreign capital to do it.
Even as the immediate domestic job market is contracting, partly because of caution and anxiety about the very same AI breakthroughs.
It's a profound tension.
So given this huge economic tension, the squeeze at home, the massive investment from overseas, how is the regulator reacting? It feels like the FCA is fundamentally changing its tune.
That is the really pivotal shift for everyone listening, I think. The FCA is strategically pivoting. They're talking about rebalancing risks.
Specifically to stimulate growth.
Explicitly. You have to remember the context. Productivity in UK financial services has basically stalled. It's averaged just 0.4% growth per year since 2015. Flatlining.
So the regulator feels it has to do something to break that logjam.
Exactly. They recognize they need to take steps to counter that inertia.
And the language they're using is certainly different. That quote from the FCA's chief economist, Kate Collier.
Yes, very direct. She stated quite clearly that risk is good.
And followed up with, appropriate risk-taking has an important role to play.
Now, for a regulator, especially post the 2008 financial crisis, that signals a really foundational change.
It does.
So for compliance and risk professionals listening, this new mandate isn't just about ticking the same old boxes. It demands a more strategic view. Where can calculated risk actually deliver growth without, compromising stability or consumer protection?
They're intentionally trying to create space for what they see as beneficial risk.
That's the idea, and we are seeing it applied in practice already, aren't we?
Yeah, things like loosening the mortgage affordability rules slightly, and the big overhauls to the capital markets and listings regime.
All designed to make the UK feel more dynamic, more competitive.
Right, inject some energy.
Exactly. But, and here's the major complication. At the very moment, the regulator is sort of urging the industry to take more risk.
Individual consumers are doing the exact opposite.
Precisely, which is creating this potentially huge conduct crisis for banks and wealth managers. We've seen this record surge in pension withdrawals.
What are the numbers on that? How big a surge are we talking?
The data is genuinely alarming. Total pension withdrawals jumped by a massive 35.9% in the last financial year, 2024-25.
36%. What's the total figure?
It hit 70.9 billion.
70 billion pounds withdrawn from pensions in 1 year. What on earth is driving that?
Well, it seems to be driven purely by anxiety. Anxiety about potential government policy changes down the line.
So speculation about future tax changes.
Yes. There's been intense speculation about maybe bringing pensions into the scope of inheritance tax or possibly changing the rules around the tax-free lump sum.
So people are worried and getting their money out now, just in case.
Industry analysts are literally describing it as customers front-loading withdrawals, pulling money out now out of fear of future tax hits.
And the real conduct issue here is that people are making these huge, life-altering decisions, often without any proper advice.
That's the absolute core of the problem. We saw that quote from John Greer in Money Marketing highlighting it.
What did he say again?
He said, nearly 7 in 10 people are making complex decisions without professional help.
7 in 10. Wow.
Which risks leaving many without adequate income later in life.
That's deeply concerning.
It is. So for wealth managers, for retail banks, trying to manage this incredibly risk-averse customer base right now.
Against the backdrop of the FCA saying, take more appropriate risk.
That is the central operational challenge, a real tightrope walk.
Okay, before we wrap up the main themes, let's just quickly touch on a couple of other areas, some positive regulatory news perhaps, and then the big one, the new crypto framework.
Good idea. First, a positive note on consumer protection, motor insurance compensation.
This shows the regulator flexing its muscles effectively.
It does. After the FCA intervened specifically to improve how insurers handle claims.
Over 270,000 motorists are now set to get compensation.
About 200 million in total shared amongst them, so that's a direct financial win for consumers thanks to regulatory action.
Good news. And also the first anniversary of the access to cash rules. That seems to be working too.
Yes, that initiative seems successful so far. Those rules require banks to assess the impact of branch closures and fill gaps in provision.
And have they filled the gaps?
Well, in the last 12 months, 121 new banking hubs have opened, plus 93 cash deposit services.
And that's maintained access.
It successfully kept cash access available for over 95% of the UK population, which, is still a vital lifeline for millions of people and small businesses.
Okay, important progress there. Right, finally then, let's tackle the new crypto framework. Consultation paper CP2525. This feels like a big step.
It is a crucial document because for the first time, the FCA is applying established, pretty robust standards to crypto asset firms operating in the UK.
So extending existing regimes.
Exactly. They're extending foundational requirements like the Senior Managers and Certification Regime, SMNCR.
The Code of Conduct, 2CON-N.
And the Operational Resilience Requirements, SYSC rules, to this sector.
So it's about bringing crypto into the mainstream regulatory fold.
Essentially, yes. Instilling that culture of accountability, making sure senior individuals can be held responsible for what happens on their watch.
How is SMNCR going to apply? Is it the same for all crypto firms?
No, they'll be tiered based on their size and complexity, limited, core, or enhanced.
And the enhanced tier is the one with the most stringent requirements.
That's right. And for firms that hold customer crypto assets, the custody firms, the threshold for being classed as enhanced is a major point of discussion in the consultation.
What's the proposed threshold?
Well, you're looking at a very wide range, actually somewhere between 1 billion and 100 billion in client crypto assets held.
That's a huge range.
It is. And crossing that line into enhanced means substantially higher governance requirements, more internal reporting, much more overhead.
Okay. And one other big point of uncertainty for firms, especially fintechs, was about using public blockchains, distributed ledger technology, DLT. Did the FCA offer any clarity there?
Yes, they did. And this is actually a really significant win for innovation, I think.
How so?
The FCA explicitly stated that using permissionless DLTs, think public blockchains like Bitcoin or Ethereum, will not be treated as a formal outsourcing arrangement under the SYSC 8 rules.
Okay. And why is that important?
Because treating it as outsourcing would have brought a whole load of contractual and oversight burdens. Really heavy stuff. This decision removes that significant regulatory hurdle.
So it makes it easier for firms to actually use and integrate with public blockchain infrastructure.
Much easier, yeah. It removes a major barrier.
Right. So bringing this all together, what does this incredibly complex picture mean for the banking professional listening today? How do we summarize this moment?
I think you have to see it as operating at a really profound inflection point, a turning point.
Okay.
On one side, you've got this massive foreign-funded technological momentum. It's pulling the UK towards this AI-driven future, huge potential.
Outside.
You have the costly hangover from past monetary policy, the QT losses, and this dramatically spiking risk aversion among domestic consumers. We see it most clearly in those huge pension withdrawals.
So the core professional challenge right now is trying to square that circle.
Absolutely. You have to navigate the FCA's new mandate, which is pushing for increased risk appetite to drive growth,
While at the same time serving a customer base whose personal risk aversion is currently shooting through the roof.
It demands an incredibly nuanced approach to compliance, to conduct, to strategy.
Yeah.
Really tricky. And maybe here's a final provocative thought for you to consider. Think about the Bank of England having to defend that 134 billion projected cost of QT. They do it by citing the supposed long-term benefits of the original QE program.
Right. It's a complex argument.
Extremely complex. So when economic outcomes are this complicated, and the fundamental metrics like the true cost of government debt or real productivity gains are being fiercely debated by economists and politicians, how do you, as a compliance or risk professional, actually measure success?
When the very definition of a good outcome seems to be shifting under your feet.
Exactly. How do you benchmark success in such a fluid, contested environment? Something to mull over.
That complexity definitely underscores why staying informed, staying sharp is just absolutely vital right now.
Couldn't agree more. That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.